All right.
Steven, man, thank you for joining us. We're excited to have you on today.
I'm excited to be here. Thank you so much for having me.
Absolutely. Today,
No, it's cool because you've got some great content on Instagram.
Yeah, he
Oh,
does.
thank you. I
Some
appreciate that.
I mean, just good little. I mean, and they're accurate, which is nice. I mean,
know
it's
it's rare,
helpful
right?
and accurate, and just straight to the point. So if you're on Instagram, I'd highly check him out. Your handle's at Snapback CPA, right?
Yep, that's right. Like a snapback hat, snapback CPA. That's me.
Perfect.
Awesome, man. Today, we're going to kind of focus on some of the tax advantages of owning real estate. So we've got a bunch of questions for you that we're going to throw at you. See if we can stump you. But before we dive into that, Steven, if you could maybe give us a little bit about your background and kind of how you got into this industry. And if you could leave out the part where you were an Idaho Vandal, that'd be great.
Hey, I'd love to. Thank you. Thank you for the opportunity here. Yeah, so I actually came from a family where you're either a doctor or you're a CPA. And so I chose the CPA route because I didn't want to go to medical school.
Smart.
My dad's a CPA, my older brother's a CPA. And so I've been a CPA for about 6 years now. I've worked at a variety of small accounting firms locally here in Boise, Idaho. And something that always consistently struck me as I was working there and working with clients at those firms was the lack of planning and the lack of understanding from the client standpoint when it came to their tax situation. And I can't even tell you how many times I would sit down with a client and it would be something as simple as taking their Schedule C business and converting it to an S corporation and getting them on a reasonable salary. And that would save them tens of thousands of dollars. And you would sit there and you'd tell them as you're reviewing their tax return, look, you owe $30,000 right now in taxes. But if you do X, Y, and Z between now and the end of the year, then we can actually reduce that and you'll pay roughly $10,000, right? Or something like that. And it always blew my mind. They would come back the next year. The same thing would happen over and over and over and over, just because they weren't getting their hand held throughout the year like they truly need to, or just not taught it enough to truly understand what they needed to do. And so when I left the last CPA firm that I was at and started creative advising, that was my main goal, was to help people understand the tax code, how the tax code works, and how it actually works in your favor. The tax code is not necessarily there to take more of your money, right? The tax code is actually written as a roadmap to help people build long-term wealth and not pay taxes at the same time. And it's just a huge misunderstanding with how the tax code works. And so that's kind of why I am where I am today, why I'm trying to push so much out through social media, and why we're trying to run our accounting firm and tax firm differently than almost all tax firms out there. And I just have a huge passion behind helping people not pay taxes and build long-term wealth.
Well done.
Yeah, man. A lot of your content revolves around real estate. Did you kind of set out to get into that niche, or how did that come about?
Yeah, great question. So when I first started my own CPA firm, the main client that I had in my mind was actually real estate agents. The reason it was real estate agents because they fall into that trap all the time of running it through a Schedule C and not doing an S corporation. And they make a lot of money, right? Most real estate agents out there make good money. And so I actually started our firm out based on real estate agents, right? Helping them understand how they can convert to S corporations, reduce their tax liability. And then as I started getting deeper and deeper and deeper, I read a few books, read Rich Dad, Poor Dad, read Tax-Free Wealth by Tom Wheelwright. I actually joined the Wealth Ability Network, which is Tom Wheelwright's network. He coached me one-on-one for like 8 months. And so as I got involved in that world, it just became so clear and so apparent to me that real estate is so much more powerful than what I had initially thought when it came to taxes, right? And I already had this client base that was already real estate professionals, already building up real estate portfolios. And so we could take these strategies and implement them really easy. And so it's just kind of evolved throughout the last few years. And real estate, I've just been pushed into real estate just because of the massive tax benefits around real estate and the misunderstanding for most CPAs about how to leverage that real estate professional status and how to leverage those rental properties to really eliminate tax liability for people.
Why do you think there's such a gap between just the typical CPA versus somebody in that space all the time?
I've thought about this a lot, and this is my personal belief on it. There's no research behind this, at least that I know of. But I just look at it from my personal situation and how I was trained and how I was brought into the industry. And I think it's very similar across the entire industry for almost all CPAs out there. What happens is you have these CPAs that work really hard, and Anthony knows this, right? You kind of work yourself to the bone, right? You work
Yeah.
really, really hard. And these CPAs just kind of get stuck in the day-to-day grind. They're doing tax returns, they're preparing them, they're spitting them out the door. They're doing audits, they're preparing it, spitting it out the door. And that's what they do all day, every day, right? Yes, we're required to do certain level of CPE and stuff like that. And we find ourselves going and doing the bare minimum just to get the credit so that we can continue our license going forward. And then what I found is as those CPAs age, they become partner level and they train those underneath them. And the same thing happens over and over and over. It's a cycle, right? And so you never get these CPAs that get a fresh look from the outs, from like a different angle or a different viewpoint of how the tax code works and how different strategies can help people. It's just the same kind of training every single year. And so a lot of the CPAs that we're dealing with now have training that's tied to the 1986 tax laws and not necessarily any of the tax law changes that have come into play through 2017 or anything that's happened throughout COVID. And it's really hard as a CPA to adjust and step back from what you've been doing every single day and then look at the tax code in a different way. And so I think it's just kind of ingrained into the overall CPA society that's how they operate, that's how they work. And you either can do something or you can't do something. And there's just not much flexibility with CPAs out there. And so that's where I think majority of the disconnect comes from. And then again, I think as COVID's kicked off, it's made CPAs' lives kind of living hell. Because all the benefits and all the benefits that came from COVID were tied to the tax returns in some way, shape, or form.
Yeah.
And there's a ton more complexity. And so CPAs have really had to put their heads down and work. And there's not enough time. There's not enough time in the day to sit back and train and teach people what they can be doing.
Well, Stephen, you dropped a few tax things that we want to talk about. You mentioned an S corp, you mentioned a real estate professional, but before we get into the weeds on there, let's talk about a little big picture.
Yeah.
Oftentimes, people talk about the tax advantages of real estate. I mean, is that true? And if so, what are they?
Yeah, great question. They are absolutely true, right? This is not snake oil salesman type stuff, right? We literally have a client last year who made over $1 million and didn't pay a dime in tax because we reinvested it back into real estate. But the tricky part is, do you qualify to take the losses against your active income or your ordinary income? That's the big thing that a lot of CPAs don't even understand, right? Is how you can actually take the losses from these investments to offset your income tax. And it's all based on a code section within the Internal Revenue Code called Section 469. Section 469 breaks your income between active income and passive income. And it was established back in 1986 with, I think it was the Reagan administration, I don't know. But the reason for that is because you had all these wealthy people who would make a lot of money in W-2s, right? Through their wages or whatever. They would take all that money, drop it into real estate, do cost segregation studies, take all these losses from those properties and eliminate their tax liability. And finally, Congress stepped in and said, no, we're not going to allow this anymore. You have to actually participate in these activities in order to make it so that you can take the losses against your income. You can't just throw your money at something and then take the losses to eliminate your taxable income. And so they established Section 469 to break income into active category and passive category. And it very explicitly says that real estate and rental activity is a passive activity, meaning that passive activity, if it drops into a loss, that passive loss cannot offset an active income from either S corporation business or a W-2 income unless you meet certain qualifications that pull it from the passive category into the active category, like being a real estate professional is a great example. And the rules behind real estate professional are also very strict and very rigid, right? It's very clear what those rules are. And I think a lot of the quote unquote tax gurus out there try to make it seem very simple to become a real estate professional when it's really not. You have to have 750 hours in a real estate specific trade or business, and it needs to make up more than 50% of your income generating activities or your time spent in income generating activities, right? So if you have a full-time W-2 job, you have to turn around and prove to the IRS that you spend more than 2,000 hours on your real estate activities and then somehow live a life with your family or whatever it is, right? So it's very difficult to actually prove a real estate professional unless you're doing it full time, right? Unless you're a full time real estate investor, unless you're a contractor or a property management company or a whatever it is within real estate already. Does that make sense? Did I answer your question well enough with as far as
Yeah.
the advantages behind real estate?
Now, well, I want to go a little deeper, but in regards to real estate professional, in summary, that will allow you to deduct those passive losses
Correct.
against other income. What if one spouse,
That's exactly what I was
right?
thinking.
You
Yeah.
want that, right?
Great
Right?
question.
You know what I'm
That's a
talking about?
Exactly. So that's actually one of the big strategies that we pull with a lot of our clients, right? Is a lot of times you'll have either a husband or a wife who has a very successful business, and they're kind of the bread earner or the earner in the family, right?
Yeah.
And the other spouse either stays home with the family, or they have some part time job, or they don't do a lot of income generating activities, right? And so a lot of times where there's a huge opportunity is leveraging that spouse that doesn't have a full time job and having them become the property management company for the real estate properties that you actually run, or have them go out and buy the real estate properties, or have them become that real estate investor. Because now, as long as you're married filing jointly, we have a real estate professional in the household, which now allows us to take the real estate losses against that active income against the business that might not be real estate focused. And so the tricky part here is we have a two-pronged test that we have to get through, right? Real estate professional is step number one, but then we also have to do what's called material participation within the activities in order to take the losses, right? So if you, for example, have a portfolio of 7 properties and you have a property management company that manages everything, by default, you're already proving that you're most likely not materially participating in those properties because you have a full separate property management company that's taking care of the day-to-day operations of that business. So it becomes difficult to actually take the losses. And so that spouse, if we're leveraging the spouse to be the real estate professional, we also need to make sure that within that portfolio, we at least have 1 or 2 properties that the spouse is self-managing. Right.
Okay.
Because then we have certain grouping elections that we can make with those properties to then group them together to treat them as one property for material participation purposes and take the losses across the portfolio instead of just those 1 or 2 properties.
Now, what I had heard, a lot of people are getting into the short-term rental business,
Yes. I
right?
love short-term rentals.
Yeah. What I had heard is that a short-term rental business may not be considered passive.
Yes. So this is a great question. And again, a huge misunderstanding within the code. Because how section 469 reads is it's very explicit on the definition of a rental property. Right. And there's 2 ways that your rental property may not qualify or be looked at as a rental activity in terms of section 469. Those 2 ways are either an average rental period, meaning the average amount of time that each renter is staying in that house is 30 days or less, and you provide substantial services to that individual or to that individual while they're staying in the property. So like, for example, if you do a month-long rental or they stay at your average stay at your place is like 2 weeks, but then while they stay there, they also have a concierge service. They have a chef that stays with them. They have all these additional services while they're at that property. That does not qualify as a rental activity in terms of section 469. Now, the other way to do it, the more simple way to do it is your standard Airbnb property, which is if you have an average rental period of 7 days or less, period, it's not a rental activity in terms of section 469. Okay. And so the tricky part at that standpoint then becomes, do we have an average rental period of 7 days or less and substantial services? Because if we have both of those factors, now we have a Schedule C business, and it's no longer even a Schedule E business or Schedule E rental, right? And so from that standpoint,
Stephen, we got to go slow for Cameron. Okay. You mentioned Schedule E and Schedule C. You mind explaining that?
Yeah. So the main difference between Schedule E and Schedule C, Schedule E is where you report your rental activity, right? Your rental properties go on Schedule E. The income generated from that subject to tax, but it's not subject to self-employment taxes, which is an extra 15 to 16% tax on top of your ordinary income tax. Okay. Your Schedule C's, that's where you have self-employment tax along with your ordinary income tax with the net income generated from that side of things. And so if you have an Airbnb property that's being reported on your Schedule C, you're going to have self-employment tax associated with that, which is not good, right? And so In terms of that, there's a lot that we do with those types of properties to ensure that we don't fall over to a Schedule C. But that's that's probably too deep in the weeds for this conversation. But with your general Airbnb property, as long as you're not providing a whole bunch of other services while those individuals are staying in the property, typically you're going to be okay filing it on the Schedule E, not subject to self-employment tax. And then as long as you materially participate, so the same rules go with the long-term rentals, right? As long as you self-manage the Airbnb property, or your spouse self-manages the Airbnb property, then at that point, we can take the losses from the cost segregation study, from depreciation, which I'm sure we'll get into here soon, to then offset your other income. And the cool thing to also note with this is real estate professional status, right? So your long-term investments, your long-term rental investments. If you want to hit a real estate professional status in order to take the losses, it has to be either the husband or the wife, or the taxpayer or the spouse. It has to be one of them. It can't be both. When you drop to material participation, both the taxpayer and the spouse's time counts, which is a very big difference between real estate professional and the material participation. All time counts between taxpayer and spouse. So they can basically work on it together and they get both of their time for it.
Okay. So that sounds great. Now, one thing I think we kind of brushed off was, what are the tax advantages of real estate?
Yes. And this is where we're going to get with depreciation, right?
Okay.
And all the tax benefits that come from real estate are based around depreciation, right? Because what's cool, and for those of you who aren't familiar with what depreciation is, the best way to look at depreciation is a vehicle. I always explain depreciation around vehicle purchase. When you drive that vehicle off the lot, it immediately drops in price. Well, maybe not right now, but in normal economies, it drops in price pretty significantly, right? And as you drive that vehicle, the value of that vehicle gets less and less and less because of the wear and tear that vehicle is going through, right? And so an average vehicle has a life of 5 years. And it gets depreciated over that amount of time, right? And so the same thing, we get to do the same thing with a real estate purchase, right? The building that sits on top of the land, we are able to actually depreciate, even if it's going up in value, which is really cool about real estate. Now, we cannot depreciate land. So this does not apply to like raw land flippers and sellers and stuff like that. But when you buy a property that has a building on top of the raw land, we can do what's called a cost segregation study on that property to break that property into 3 main components. You have structural components, land improvements, and contents. Those are your 3 main components that are built into a real estate property. Now, what most CPAs will do is if you buy a real estate property for, let's say, $350,000, and it's a rental activity, okay? What most CPAs will do is they'll take the $50,000 and they'll call that the value of the land. Okay. And then the $300,000 is what's called your depreciable basis in the property. And they'll take that and they'll divide it by 27.5. And they'll just divide the entire cost of the property by the quote unquote structural components. The structural piece of depreciation for that rental property is the 27.5 or 39-year property, if it's a commercial property. And so where the power behind cost segregation studies come into play is it breaks the property into those 3 components that we just talked about. And the land improvements is 15-year property and the contents is 5-year property. But where this becomes really powerful is bonus depreciation, because bonus depreciation is a special way to depreciate assets that allow you to take the entire cost of that asset in the first year that you place it in service. Okay. And so where that becomes really powerful is what we've found as we've done a lot of these cost segregation studies over the past couple of years is the land improvements and the contents actually make up roughly about 30%, completely depends on the property, but it makes up roughly 30% of the depreciable basis of that property. Okay. So if you have $300,000 of depreciable basis, about 30% of that is just under $100,000, right? And so with that situation, you theoretically can take anywhere from an $80,000 to $100,000 loss in that first year that you place that property in service, because you're able to bonus appreciate that land improvements and the contents of that property in that first year that it's placed in service, which then allows you to take that loss and offset your W-2 income or your business income if you meet those qualifications that we've been talking about, right? Which is where we want to pull it out of the passive category and move it into the active category. Okay. So these tax structures and the tax strategies behind these are very complex. I would never recommend someone doing this on their own without talking to a tax professional that really understands what you're doing, because you can get bit really hard for it. And so then from that standpoint, you're doing that every single year, right? The first year you buy one, you save $30,000 in taxes or whatever it is. You then take that $30,000 tax savings, that's your new investment, right? That's your down payment on your next property. Then the next year, you're going to buy two. And then the following year, you're going to buy four. And then you're going to buy eight. And then you're going to buy 16. And you can build this portfolio really large, really quick. Because what you have to remember is this is not a strategy where it's like, I bought a property, I'm going to buy another one in 3 to 5 years. You don't want to do this strategy if that's your game plan. Because when we take those losses up front through depreciation, it reduces the amount of depreciation that you're going to get every single year. And now, as you go into year 2, 3, 4, 5, and beyond, that property is going to start cash flow, and it's going to show taxable income. And so you have to be reinvesting into more property in order to continue to offset that rental income as well as your W-2 and business income.
Okay. So what I'm hearing with in summary, a cost seg allows you to get more deductions in the first year.
Exactly.
And what you're giving up are deductions in the future years.
Exactly. So if you look at it from like a graphical standpoint, I basically break this out into 3 graphs. If you just do it from the traditional method, you're taking, let's just throw numbers in here, at $10,000 a year in depreciation on a $300,000 house, roughly, right? You get $10,000 of depreciation expense every single year that goes directly against the cash flow from that property to reduce or even eliminate the taxable piece of the rental activity. Okay. Now, when we do the cost segregation study, instead of it being a flat line, it's more of a curved line, right? For the first 5 years, we get a lot more. Then the next, between year 5 and 15, we get a little bit less because now our contents are fully depreciated. And then between years 15 and 27 and a half, we get a little bit less because now all of our land improvements and our contents are depreciated. So it's kind of a step down as you go. But then when we bonus depreciate, we're taking all of the land improvements and all of the contents in that first year, getting that really big hit in that first year. And then we go directly down from year 2 to 27 and a half, we're down to just getting that structural component. Where typically, if you go back to that example, if we were to put numbers on the $300,000 depreciable basis, I believe you would get anywhere from $80,000 to $100,000 that first year, and then it would probably drop to like $3,000 to $4,000 in depreciation expense every single year thereafter. So we're just front loading that expense. You're not getting more expenses from the property. It's just front loading that depreciation.
Okay, so what I'm hearing is that we get that big depreciation that first year. And again, I know the numbers you're giving us are kind of are not exact, but and I know CPAs don't like to give estimates or but what I'm thinking is that's about the equivalent of your down payment.
It's a little bit more, actually.
A little bit more.
And so if you buy a $350,000 property, typically you're out $70,000 for it, right? So $70,000 out of pocket, you actually get anywhere from an $80,000 to $100,000 deduction in that year, right? Which is pretty substantial. And then the actual tax savings, if you did a $70,000 down payment with the full 20% down, you're probably looking at like a $50,000 tax savings. So it's a little bit less than your down payment, but in that arena.
Now, Steve, I know you and I haven't shedded too much in our philosophies, right? But we're personally not big fans of IRAs. Again, we're trying to create financial freedom. You can't do that if your money's tied up. And we have a lot of clients that are taking money from an IRA. I mean, some are using the self-directed IRA. We've done the math, and part of the motivation for us doing that math was actually Tom Willowright, because he has some of that in his course about having money in an IRA versus outside. So we do have some videos and some contents on that. So we will put that in the show notes.
Nice.
But what I'm kind of hearing is a lot of money. A lot of our clients are like, hey, this all sounds great. I like infinite banking. I like real estate, but all my money is tied up over here. And so sometimes, they will take the money out of their self-directed IRA pay the tax and the penalty
Mhm.
to invest in real estate.
Yep.
But what I'm kind of hearing in this example, you take money out of your IRA for the down payment. That, let's just say in this example, we took $80,000 out, but if we have an $80,000 deduction, we're in essence kind of offsetting that
Yeah.
income.
Yep, you absolutely are. And that's another key strategy that we work with a lot of people on, because I'm from the same mentality, right? I hate IRAs. I hate 401ks. I
Mhm.
do not like them at all.
Yeah, like
And the reason for that, and I'm not even a huge fan of self-directed IRAs, because you're basically forfeiting the tax benefit from those if you're in a traditional IRA. Because you can't cost seg it, you can't do any of these things and reduce your tax liability now, which from a time value of money standpoint is the best thing to do, right? And it's all deferred, and then you'd even have to pay tax on it when you pull it out of the IRA for the most part. And I just hate them. So a lot of what we do is based around, does it make sense to pull money out of that IRA or 401k, pay the penalty, and then invest it? Now, the trickiest part is making sure that you do it in a smart way, right?
Yeah.
Because if you're going to take, let's say you have a $200,000 401k out there and you want to pull it all out. If you pull that $200,000 out and then you only invest $60,000 as a down payment, you're going to get screwed, right? You're going to have a huge
Mhm.
tax bill. They're going to take a lot of that money from that 401k. And so we usually only encourage it if you already have a property that you're going to be putting money into. And then you take just the amount that you're going to be doing as your down payment, because you want it to be dollar for dollar, so that it offsets perfectly and you don't have to deal with the extra tax. And then we just plan for, yes, we got to pay that 10% penalty. We're not going to be able to eliminate the 10% penalty because it's a below the line penalty, right? And so we can't do anything about that, but we can at least eliminate the actual income tax associated with the distribution to you. And so 9 times out of 10, it usually makes sense to do that. But again, it's a very delicate process. You want to make sure you're going through it with sets of professionals that know what they're
Mhm.
doing and the ramifications of what you're doing.
Yeah, and before anybody just calls their Fidelity or their Schwab account,
Yes.
you, you got to plan for this, because also, like you mentioned, in order to take that deduction, you need to qualify for it.
Yep.
So we got
Exactly.
to make sure you qualify as a real estate professional.
Mhm.
Why? That's where where I think it's imperative. If you want to get into real estate investing, you need to work with a CPA who understands real estate, because there's a lot of these nuances that you're not going to find in TurboTax or your uncle or H&R Block. It's important to have somebody who has that experience.
For sure. Absolutely. I can't say that enough. And a lot of people, even like I do, so I do free 15-minute consultations when I first talk to somebody, right? So anybody who's new or hasn't talked to me before, I'll talk to you for 15 minutes for free. A lot of times they'll take that information and run with it, right? And they'll go try to do all this stuff, and then they'll come back to us for tax preparation. It's like, dude, we didn't do this right, and they'll get frustrated. It's like, it's not something that you can sit down and talk to somebody about for 15 minutes and then do everything correctly, right? That are very, very complex. It needs to be multiple conversations, up to an hour long each time you talk to somebody as you're going through the process to make sure you're doing it correctly. So they're very delicate processes.
Steven, I've been around Vegas and we've interviewed previous accountants, CPAs before. And man, I was really impressed there. I would say that was probably one of the best explanations I've ever heard on that part of it. A lot of times we'll ask somebody, hey, is there ability to offset any active income through passive activity? And they say, no, can't do it. Right.
Yeah.
And you're like, right. So
Yeah.
well
Yeah.
done, man. That was great.
Thank you. I appreciate it. And again, it comes down to the rigidness of most CPAs out there. And the reason they're saying no is because their trainer told them no,
Yeah.
and their trainer's been in the biz for 50 years probably. So
I've got a question for you. We're talking about kind of rental properties and stuff. And I know that this is maybe a misconception a lot of times, but I'm going to tee it up for you is if somebody's buying a rental property, how important is an LLC and what is the purpose behind that?
great question. So I'm not an attorney. So always get advice from an attorney. I'll tell you what most of our clients do and what we do with them and what I've learned from the attorneys that we work with. LLCs are not there to change your overall tax. They don't change your taxes, right? LLCs provide flexibility from the tax standpoint. They do not actually change your taxes. We can do different elections to change the overall tax liability, but the LLC itself does not change your tax. What it does do is it offers a good amount of asset protection as long as you structure it properly and then you operate within the LLC properly, right? The LLC is there to make it to where if someone slips and falls in your property, or a better example is someone's upstairs washing a window and the window pane falls out and they fall out of the window, and it's something that you should have repaired years ago and you just never did. Okay. That's something or a situation that that tenant can come and sue you for, right? If they sue you, and your property's in your personal name, they have the ability to come after any of your personal assets along with that lawsuit. If we take that property and we deed it to an LLC and then we treat it properly within that LLC, they can only come after what's within that LLC, right? And so if you have just the one property, maybe a little bit of cash in that property, in that LLC, they can only come after what's within that LLC. Now there are additional things that you can do along with that, right? You can set up kind of a tiered structure, which is what we do with all of our clients. Is we usually do a Wyoming holding company. That's an LLC. So we do a Wyoming LLC that basically holds the ownership of all the subsidiary LLCs that then actually own the properties. Okay. A big confusing part around this is why we do that. The main reason we do that is because Wyoming is what's called a non-disclosure state, meaning you can't look up who owns the different LLCs within that state. And so again, if you set it up properly within Wyoming, people won't be able to figure out who owns that property. So it doesn't reduce your chances of getting sued, but what it does is it makes it so that individual who's suing you doesn't know if they're suing Jeff Bezos or if they're suing some dude that just went through bankruptcy and doesn't have a dollar to their name, you know? So it just makes it very difficult to figure out who they're actually getting into a lawsuit with. And most attorneys look at that structure and kind of understand that individual knows what they're doing and won't pursue a lawsuit against that structure. So there's a lot that you need to do within the day-to-day operation of that LLC to make sure that you're not doing what's called piercing corporate veil and commingling accounts and stuff like that. Another big misconception that we talked to a lot of people about is whether or not you need one property per LLC or you can put multiple properties into an LLC. And the main thing that you got to look at is each state needs its own LLC, right? So if you have properties in Florida, properties in the Carolinas, properties in Arizona, right? You should have a Florida LLC, a Carolina LLC, either north or south, and then an Arizona LLC. And those are the LLCs that are actually going to own the property. And then those LLCs can be owned 100% by your Wyoming holding company. But each state needs its own LLC, and you can put multiple properties into one LLC. It's just what your risk tolerance is, right? If you're okay with multiple properties being at risk at once within that state, then you're good to lump them all in. Most of our clients have like a $1.5 to $2 million threshold, whereas if they're putting a values of the property in excess of $1.5 to $2 million, we'll open up a second LLC within that state and have multiples. And so if you're dealing with like large complexes, like apartment complexes and stuff like that are already very expensive, usually we'll put those in their own LLCs. If you're dealing with smaller properties, like $80,000 to $120,000 properties, we'll put 15 in one LLC with no issue, as long as they're in the same state.
Now, a lot of people are buying the rental properties with a mortgage.
Mm-hmm.
Now, not all the banks like it when you transfer ownership. So you want to speak on what the options around that?
For sure. So there's two options that we can go through. Well, there's probably more than two, but the two that I know of and that we work with our clients on. The first one is banks. I've heard rumors that in more recent times, banks have become more friendly with the due on sale clause, which is what we're dealing with and what we're talking about here, right? When you transfer a property out of your personal name and the bank has placed the mortgage on you personally, when you transfer that property, it's then a transfer of title, which triggers the due on transfer clause within the mortgage, right? The bank can call the note due at the time of transfer. And so one way that we've talked a lot about getting around it, and again, you want to make sure you talk to an attorney about this. Don't take this from me. This is not CPA advice. Speak with an attorney, a real estate attorney that knows what they're doing around this. You can actually wait for the bank to sell the note to whoever's going to hold the note for the life of the note and then transfer the title, because they only are going to pull that title when they actually are selling the note, right? So that's one thing you can do. Also, another thing you can do is you can talk to your banker to see if there is a due on transfer clause within the mortgage. I've heard, again, this is rumors, that some of the more recent mortgages being written up do not have the due on transfer clause, which is hard for me to believe, but I've heard it a couple times. So maybe it's true. Now, if that's something that worries you and you do not want to even run the risk to push back on the banks and any of that kind of stuff, you can do what's called a land trust. So basically what we do is we transfer, or we make a trust that's called a land trust, that you as the grantor are giving that property to the trust, and the beneficiary of that trust is the LLC that you want to have the ownership of that asset. And so we're not even transferring the title, but through that trust document, that trust agreement, we're able to roll the ownership underneath that LLC. So there's two options that you got to go through with that. Both options, I would talk to a real estate specific attorney on, to make sure that you're doing it properly and you're looking at everything that you need to be looking at for both of them.
Well, and again, we're kind of right. We came and talked about tax advantages of real estate, but then we started talking about LLCs and
Yeah.
kind of all this other stuff. Now, and I tell you, we will. I don't know if you follow Aaron Chapman, but we've had him on the show many times, and he specializes in mortgages with real estate.
Beautiful.
And we will have him on again because Fannie Mae and Freddie Mac are allowing, under certain criteria, allowing you to transfer to an LLC.
There you go. Those are probably the
Yeah.
rumors I've been hearing.
Yeah.
I like it. Cool.
Steven, I got a kind of broad, generic question for you.
Mhm.
Right? The market's crazy. Interest rates are high.
Yeah.
Why are investors still buying properties?
Dude, property. Whew, honestly, it's a stable investment. First off, this economy that we're in right now, and the market that we're in, is vastly different than 2008, as far as real estate goes. We're in an inventory shortage, which was not the case back in 08. There's a lot of factors around there that are leading a lot of economists to think that the real estate market's probably not going to budge much. And in fact, it might just hold steady for the next year and a half. And then at the end of 23, we might see another spike. So there's a lot of economists saying a lot of different things about it. But honestly, the best route for real estate, and the biggest reason I think people are still pouring in, is it's a great hedge against inflation, right? As inflation's going crazy, people don't want to hold cash. And the best place to park it to hedge against that inflation is real estate. And the combination of that, along with equity growth that we're still seeing, along with the tax advantages that we're seeing right now because of bonus depreciation. That 100% bonus depreciation was only new within 2017's Trump tax changes, right? And actually at the end of this year, starting 1/1/2023, it goes from 100% down to 80% unless Congress extends it. So the tax benefits are going to start coming down over the next few years when it comes to real estate. But it's just trying to figure out different ways to go about it, right? We'll start doing combination of Section 179 depreciation with bonus depreciation. And again, talk to your CPA about that. Make sure they understand what they're doing, because you can kind of combine both of them to make sure you're getting the best benefits, both on the state side and the federal side. And so I think there's a lot of reason people are still piling into real estate. I don't see it slowing down. I mean, I think it will slow down. Who I honestly feel bad about right now is the everyday person trying to get into a home, because interest rates are starting to creep up. It's getting harder and harder for them to get into a property, because they actually rely on those mortgages in order to get into the property. Whereas your high level investors, they're okay coming in with 30, 40, sometimes 100% cash down, turning around and then cash out refinancing it or doing whatever. You have a lot of hedge funds buying up massive amounts of properties right now. There's just a lot of weird stuff going on in the real estate game. But I don't see it slowing down. I just don't. But again, I'm not an economist. I'm not in it every single day, but that's just me.
You're not an economist, but you're a very good accountant. And man, you knocked out some of these questions out of the ballpark. Well done, Steven.
Dude, I appreciate it. Thank you.
Absolutely, man. Hey, if somebody's listening, which I know they are, where can they find you? What's the best place to look you up at?
Dude, the best place to find me is on Instagram and TikTok. I know it's weird. I talk to probably about 15 people a week from TikTok.
Oh, that's awesome.
Cool platform. If you don't have it, download it and just follow me. I can be your only follow. It's okay. But TikTok's a great place to find me, as well as Instagram. I'm Snapback CPA, so like the Snapback hat, Snapback CPA, across all social media platforms. I'm not super active on LinkedIn. I'm not super active on Facebook, but I'll still interact with you if you reach out through those platforms. We also have a YouTube channel that, again, I'm trying to develop and get more active in. I'm an accountant at heart. I'm trying to get into this marketing social media world as best as I can. It's a slow process, right?
Yeah.
But then from there, we usually jump on an email and then jump on a Zoom call and then chat for a little bit. So, yeah, just reach out any way that's easy for you. You can also reach out via email. My email is Steven, STEVEN at creative-advising.com.
Awesome.
So
we will grab that. We'll have it in the show notes. But before we wrap this thing up, I know you do live webinars as well.
Yes,
right?
thanks.
You
for
got one
reminding
coming
me.
up.
Yes, we do have a live webinar. It's actually our first one that we're doing. We're going to go over our 5 steps to basically eliminating your tax liability through real estate investing. So a lot of the topics that we touched on briefly here, we're going to be going into detail on those, and I'll be actually sharing my screen and drawing all over it with the structures and all sorts of cool stuff. That first webinar is going to be next week on July 18th at 6 p.m. Mountain Standard Time. Okay, so put it in your calendars. Jump onto any of my links within any of my socials, and it's the first one on there. Sign up for the webinar. Drop your name, drop your email. We'd love to have you there. Ask questions. Come with your notepads of questions and ask them. I'm huge. This is my zone of genius. Getting out in front of people and teaching people about this complex stuff. This is what I love to do. This is what gives me energy. So please come with your questions ready, and we'd love to see you there.
Awesome, man. And we know that you're going to have some more. So what we'll do is when we put this thing out on the podcast, we'll make sure we include the link to your next one.
Perfect. I appreciate it. Thanks, guys.
Awesome, man. We appreciate you. Thanks, Steven.
Yes, thank you.
Thanks, Steven, and go make it a fantastic day.
Take care.
Hey, you as well. Thank you, guys.
Let me, boom.